Hello everyone, in this video I will be covering Forex market and alternate sources of finance. Now starting with Forex market, it is a market in which exchange of currencies take place of one country into another at a prevailing exchange rate. Uh, Forex market, no, Foreign Exchange Management Act was passed in 1999 and it was implemented in the year 2000. Forex market actually has easy liquidity. It has 24-hour work and it is decentralized and does not have any physical location. The main functions are transferring of money, credit function, like it offers short-term loan to importers, and hedging function. Hedging basically means aversing the risk, so it hedges against the foreign exchange risk. The settlement mechanism of foreign exchange market happens in four ways. First is ready or cash. It is for same day settlement. Next is TOM. TOM is for the next working day settlement. Spot is the second working day of the settlement, when settlement happens in the second working day. And forward is when settlement happens in any day after the second working day. Now, forward rate is spot rate plus premium on spot minus the discount. Now, so there's few factors which determine the foreign exchange rate. First are some fundamental factors that are balance of payment of the country. Balance of payment is basically a statistical statement which includes all the exports, imports, and other economic transactions. Second is economic growth rate of the country, and third are the current interest rate of the country. Now, foreign exchange can be like the it can be denoted in this way, like 1 USD is equal to 48.10 slash 11 rupees, like 1 rupee. Now, in this 48.10 is the buying rate. Like if I want to buy 1 USD, I will have to give 48.10, and 48.11 is the selling rate. Like if I have to sell 1 USD, then I will have to give 48.11. So yeah, and the difference between them, which is one paisa, this is called the spread. Uh, so yeah, that is all. This elimination technique is for numericals, and this can be like that. There lies direct and indirect quote. Direct quote is basically when foreign currency is expressed in terms of your local currency, like 1 USD is equal to 75 INR. This like in direct quote, your local currency is variable, and in indirect quote, it is when your local currency remains constant and foreign currency is variable, and these two are related. These two are inversely proportional, which is obvious. Now, let us look into the roles of RBI in the forex market. First is it grants authorized dealers license. This power is given to RBI by the Section 10 Act of FEMA. There are three kinds of authorized dealerships. First are AD1. AD1 are the all current and capital account transactions, commercials, and corporations and urban corporation. No, state cooperative and urban cooperative banks. So all commercial, state cooperative, and urban cooperative banks included in AD1. Second is AD2. These are specific non-trade related current account transactions. These are permitted by FFMCs. FFMCs are full-fledged money changers. We will learn about it here. So these are upgraded FFMCs and cooperative banks, RRBs, and others. So in AD1, all current and capital account transactions happen. In AD2, specific non-trade related current account transactions happen. In AD3, specific foreign transactions incidental to business and selected financial and other institutions happen. Now, a fourth one is full-fledged money changes, FFMCs. These basically purchase of foreign exchange happens and say purchase and sale of foreign currency for private and business visits abroad, or yeah, this is done by urban cooperative banks or other FFMCs. For license of a single branch FFMC, minimum net worth of fund should be 25 lakh, and for dual branch it should be 50 lakh, and this is for foreign currency purchase and sale for private and business visits. So yeah, like all this have their specific functions. Uh, Firstly, there are three kinds of ADs, and one is FFMC. These are the people who are given authorized dealer's license to like access the foreign exchange market and take part in foreign exchange transaction. Now, second is maintaining of foreign exchange reserves. This is the second function of RBI in the foreign exchange market. Foreign exchange reserves are basically the foreign currency assets plus gold reserve plus special drawing rights plus the reserve position IMF. So all this add up to your foreign exchange reserve, and this is basically maintaining this for the country is one of the role of RBI. Third is intervening the foreign exchange market in case the value of rupee needs to be stabilized. So yeah, this is one function. Now these are all the roles of RBI. Next, we will know what is ECGC. ECGC is basically Export Credit Guarantee Corporation. This was initially set up to export Risk Insurance Corporation in 1957, and then the name was changed to ECGC in August 2014 under Ministry of Commerce and Industry for providing export credit insurance and trade related services. Let me just highlight it. Uh, hmm, yeah, this was initially whatever it provides basically export credit insurance and trade related services. It actually provides guarantees. It was established and changed to ECGC in August. It provides types of guarantee to export credit insurance and trades. We will just understand like first is packing credit guarantee. This is basically for an confirmed trade export order or construction work abroad. Claim of 66% or two-thirds of its loss is returned. Second is post-shipment export credit guarantee. This is the protection given to banks against non-realization of export profits. For this, 75% is covered. Third is export production and finance guarantee. For this, 66% or two-thirds of the loss is covered. Fourth is export performance guarantee. For this, 75% loss is covered. Like for export production means if you produce something for export and then something happens and they don't give you the specified amount, then this kind of guarantee is given. And for performance, like if for some reason the performance is not up to the mark for some kind of export. Now this is export finance overseas lending guarantee, and I am not sure how much in this it covers. I think 66%. Uh, let me just check how much is covered in export finance overseas lending guarantee. Okay. How much is in export overseas? Yeah, around 90% of the loan is covered. This is actually a lot. So, uh, yeah, it is a bit slow. I don't know why this happens in Evernote, but yeah. Next is FEDAI. FEDI, basically, FEDI is Foreign Exchange Dealers Association of India. This was established in 1958 and it is recognized by RBI as well. It is a self-regulatory body for foreign exchange in India. This is important. Yeah. Now, there can be electronic modes of transmission of money like SWIFT. This is Society of Worldwide Interbank Financial Telecommunications. CHIPS, clearing house interbank payment system in US. CHIPS with FedWire. It is another US payment system operated by Federal Reserve Bank. CHAPS, it is Clearing House Automated Clearing System. It is British equivalent of the CHIPS in London. Target, Trans-European Automated Real-Time Gross Settlement Express Transfer System. It is an Euro transfer payment system. Sixth is RTGS of India. That's managed by RD Hyderabad, RDBRT. And last is NEFT. This is basically all kinds of electronic modes of transmission. Like this is an alternate financial, not all. Oh, I don't know why it is actually done in foreign exchange. Okay. Next is liberalized remittance scheme. It was introduced by RBI in 2004 to facilitate outward remittances up to 2,50,000 USD per financial year abroad for any kind of permissible purpose. Yeah. Now let's look into some type of NRI accounts. First is NRE account. In this, rupee is like it is a rupee dominated account. It was opened in India in the name of an NRI to park his foreign earnings. His foreign earnings. Interest earned is tax free, I think. Yeah, tax free. And currency risk is there, uh, definitely. And savings and current account and term deposits all are allowed. Second is NRO account. NRO account is also rupee account for income generated in India. Next is it limits up to USD 1 million a financial year. It is taxed because since the income is generated in India, so it is taxed and there is no currency risk as it is in rupee only. And savings and current accounts both are allowed. Third is FCNR. FCNR only term deposits are allowed and it is done to park foreign income in foreign currency in India without conversion, like without conversion of the currency. It is tax free and no currency risk is there as it remains in foreign currency. Last is SNRR. SNRR is kind of a current account and it is for business purpose. It is maintained in rupee and taxable and currency risk will be there for payment received in rupee if repatriated at later date. Yes, obviously that is only the reason for currency risk. And then next is what is devaluation? Devaluation is basically deliberate reduction to make domestic currency less expensive, which is actually RBI doing these days. Revaluation is just the opposite. It is deliberate attempts to increase the value of your domestic currency. De-dollarization means diversifying your investment. Internationalization of rupee basically means promoting the use of rupee in international trade. These are just some of the terms. Interest rate parity. This shows the relationship between interest rate and exchange rate of two different countries. So, yeah, yeah. Interest rate parity shows the relationship between interest rate and exchange rate of two different countries. Forward exchange rate, there is a formula for forward exchange rate. It is equal to spot exchange rate into 1 plus interest rate of one country A to the power n divided by 1 plus interest rate of country B to the power n. Next is what is dirty float? Dirty float is basically government occasionally intervenes to influence exchange rate called dirty interventions. Since government is not really supposed to intervene, so these interventions are called dirty. Next is sterilization. Sterilization is conducting of offsetting transaction to maintain the desirable level of money supply by the central bank. This is also being done by RBI. Also, that finally there are some risk in foreign market. This is transaction exposure, translation exposure, operating and economic exposure. These are understandable. So I will be moving on to alternate. Uh, yeah, I will be moving on to alternate sources of finance. Now, this is just a very a small chapter. Okay, so basically there are I think yeah, nine kinds of alternate sources of finance. First, leasing. Leasing is when a leasee grants lessor the right to use his or her asset for a specific period of time in exchange of fixed payments known as lease rentals. So, fixed payments are known as lease rentals, and also the ownership rights stays with the real owner, like lessee. So there are different types of leasing. First is based on terms of lease. Terms of lease is operational. One is operational and service lease. Second is financial lease. Operational and service lease is short term and cancelable. Financial lease is full payout lease and it is for long term. Based on method of lease, it is an sale and lease back. Sale and lease back basically means when the owner is given the asset for cash and because for some reason they might need cash and then leases back that asset with periodic payments known as lease rentals and then uses that asset. Second is direct lease, like it is normally just giving the asset for a sum of money. Third is based on the parties involved, single investor lease, like only the lessor and lessee is involved, and leveraged lease, three parties like lessor, lessee, and financial institution is involved. Fourth is based on area. Based on area, there can be domestic lease, like parties domicile of the same countries. International lease, they are domicile of the different countries. Now, this was with leasing. Leasing. Second is franchising. Franchising is basically if a company is owning a brand name and it gives license to give its gives license to his franchisee to use its name and expand the business. Like for we can see for McDonald's, KFC, Coca-Cola, this is what happens. Now this can be of three types: product franchising, business franchising, and management franchising. Like for product franchising, they your franchises basically sell your product. For business format franchisee, your franchises use your trademark as well as your format of business. Like for McDonald's, you can see that each franchisee, of all the franchisee of McDonald's, have kind of same operating system, same kind of taste, same menu. So that is they are copying the business format. Third is management franchisee. Management franchisee, like the franchisor acts as a mentor and acts as a mentor for their franchisers. It is done by Hilton, Hyatt, and all. Third is alternate source of finances, factoring. In factoring, the monetary transaction in which a firm's okay, yeah. Factoring is basically, for example, uh, a firm they have their bill receivables, they sell that bills to a party or known as a factor at a discounted price for an immediate cash if a firm is the party, like the third party charge a certain amount of commission, and that commission is known as the discount at a lesser price basically, and the ownership of the bill is transferred and it now belongs to the third party like factor. So yeah, it so what happens is firm sells bill and to third party or factor and at discount, and ownership is transferred. This is what happens. That can be of two types. One can be with recourse, like the factor has the right to collect the unpaid invoice if whoever is obliged to pay the amount to the factor. If they don't get it, they can collect it from the seller of the bill, and without recourse, if they cannot collect it from the seller of the bill, so they have to bear all the losses. Now, there are two types of factoring. One is domestic factoring. This is a number of days allowed for it is 90 days payment period, and then 60 days grace period is there. And for international factoring, the seller, obviously the seller and debtor both are of different countries. Now, Factory Regulation Act 2011, like it was Uh, it came in 2011 and it was later on amended in 2021. It states that in, an, any entity conducting factoring business has to register with RBI as a non-banking financial company (NBFC). Also, trade receivables and e-discounting system. This is an online platform. It is endorsed by RBI. This is for financing trade receivables for MSME. So this is a platform for factoring basically. Next is forfeiting. Forfeiting basically deals with medium to long term receivables. It is used for capital goods which are used in production, non-recourse. Like the process of forfeiting is an exporter sells a good to importer. Importer issues the invoice to the exporter. The exporter produces the invoice to an export factor. Export factor pays the amount to the exporter. Now the export factor has the invoice and they send the invoice to the import factor. On due date, the import factor collects the amount from the importer and then import factor pays export factor after collecting the payment. So yeah. Yeah. Now, this is the whole process. Now, next is crowdfunding. Crowdfunding is basically generating little amount of money from a lot of people and then generating a lot of money for a common purpose. There are five kinds of crowdfunding. One is reward crowdfunding, in which, if you give me money for whatever my cause is, you will get early access to the new products or services. One is equity crowdfunding. You will get a share of your equity. Next is debt-based crowdfunding, and one is litigation crowdfunding. It is basically for fund to fund litigation for a common cause. They all crowdfund, and one is charity donation-based crowdfunding. Now, the advantages of crowdfunding are basically financial crisis is reduced in it. If you share your business idea, you might get validated or may get better suggestions. It provides a kind of guidance and feedback. Now, the drawbacks of crowdfunding is someone can steal your idea. Um, it requires a lot of time and effort, and there is always a possibility of failure. Next is an angel investor. So, angel investor are the people who invest less amount of money, but they invest in startups and they are not involved in day-to-day functions, and they also decide quickly whether they want to invest or not. One example is Ratan Tata. Next is venture capitalist. These are kind of the opposite of angel investors. Like they invest in high amount and they also don't invest in startups. They invest in a little established business and they are fully involved on daily basis on day-to-day activities of the company, and they like properly decide whether they want to invest in that company or not. Now, next is peer-to-peer lending. This peer-to-peer lending is basically lending, but without an collateral. Now, there are rules by the RBI for P2P lending platforms. First is they require a certificate of registration. They need to register as an NBFC, and company should be incorporated in India. And the net owned fund of P2P platform should be 20 million minimum. Now, there are some general guidelines like they should maintain a leverage ratio, which actually shows the riskiness of a company. Leverage ratio should be maximum 2. Next is a single lender can lend up to maximum of 50 lakh, and lender who is lending more than 10 lakh should produce a certificate from the CA that is net worth is at least 50 lakh. Now, a single lender can lend at maximum of 50,000 to a single borrower, and also maximum loan a single borrower can take is 10 lakh. And all the lending of P2P should happen through an escrow account. So these are very important. Yeah. Now, last is public equity, which is well known how equity shares work. So that is all. Now, for all of this alternate sources of finance, now basic thing should be kept in mind that your social cost should be always lesser than social benefit. So that is all. And by social cost, we mean private cost and external cost. And for social benefit, we mean private benefit and external benefit. So that is all. We are done with both the chapters. Thank you.